The price of oil has recovered from the lows seen earlier this year. That was in February. But news from the sector, including the relentless pumping of crude by the increasingly cash-strapped oil-producing nations, seems only to cap crude out at about $50 a barrel level, or lower if you're looking at US crude. We're speaking now to the fund manager of the Junior Oils Trust, Angelos Damaskos. Angelos, welcome. I think if you look from the 1st of January to where we are at the moment, we're about 22% up on the price of crude, which I think mirrors your fund's performance year to date. Just to praise the fund, because it's small cap oil and gas, isn't it?
Yeah. We are focused in smaller to mid cap companies, but in the last year or so of stress in the market, we have focused on the producing companies as opposed to the exploration plays. And the main premise for that was that we didn't want to rely on companies that needed to draw financing from the capital markets to finance their operations. We needed to see companies that were self-sustainable. There has been enormous stress in the market, as you can imagine, because even among the producing companies, there were balance sheet issues that had to be worked out. There were marginal cost of production issues that had to be sort of prioritize the operations among companies. So with a dramatic continued decline in oil prices, management teams were at a loss as to what to do. So it really takes a very capable and very determined management team to survive such a dramatic downturn. And we have had some disappointments, naturally, over the last couple of years, but there have been some other companies that have performed exceptionally well.
Well, let's take a look at your holdings, if we can, the top 10 holdings. We've spoken in the past, and this video is available on the IG platform. We've spoken about Serica before. We've spoken about FAR before as well, the Australian company. And you've got companies here which should tend on the whole to be less than $1 billion in market cap. What's your pick here? I mean, these are percentage holdings, the top 10 percentage holdings of your fund.
Yes, and you can see some fairly heavy weights in these top 10 holdings. And the reason for those heavy weights is not by design necessarily, but because of outperformance, because these holdings have outperformed the portfolio and the sector in general, and naturally they have climbed on top of our portfolio. So among all these success stories, the latest one is a company called Cooper Energy, which is an Australian-based company with operations in the southern Australian basins. And the secret for the success story is that they control a very sizable gas deposit offshore West Gippsland in Australia, which they are moving now to finance on a project finance basis, and they have obtained some very attractive farm-in deals with partners. And the key to that is that that region of Australia is very short of gas. So the traded prices for natural gas are more than double the world average. And therefore, any project that is in the vicinity and can supply with relatively cost-effective logistics will rate at a premium. So they would expect to generate a very significant level of free cash flow from this project once it comes into operation sometime next year.
Another pick from the top 10? Another
pick is a company called Yangara Resources, which is a Canadian operation. It's in northern Canada, and it's a shale gas and oil play, but it is one of those, they control some of those deposits that have a relatively lower marginal cost of production. So even at $30 a barrel, WTI that is, they can still generate a positive free cash flow. And they have survived the downturn fairly well, even though they have been hit very hard by the market in terms of their share price because of the worries surrounding the shale producers, and investors worried that people will go down into loss-making operations. But I think now the latest drilling results and production rates and operating metrics have started to demonstrate to the market their viability and their potential profitability once oil prices recover. And a key point to that is that as oil prices recover, the margin expansion for this type of operation is very, very significant. So you would expect to see a significant share price re-rating on the back of that.
Indeed, if we look at the way in which crude has moved over the last couple of years ago. This is rise that we've seen. In terms of the background to the fund and the oil price, how do you see things developing? I mean, there's been a lot of mixed data recently. I mean, we've seen unexpected drops in inventories at a time when we're moving from that period of downtime for some of the refiners when they go from the driving season into the winter fuel season. So that would expect an upward pressure on crude. But at the same time, as I said at the top, you've got some of these cash-strapped oil-producing nations relentlessly pumping.
Right, yeah. Well, from most of the data I have seen from the most reputable research organizations, we are still in an oversupply situation. So there is more supply into the market than there is demand. On the other hand, the IEA, the International Energy Agency, updated its demand figures from last year to 1.4 million barrels a day growth. And they expect this year to be another 1.3 million barrels of growth. If you look at the natural decline of the global production capacity and you look at the prospective new supply that should come into the market over the next year or so, my question mark is, with all these dramatic capital expenditure cuts across the industry, which have taken place over the course of the last 2 years, how much of that expected supply will actually be available next year? So if we find ourselves next year into a finely balanced situation of supply-demand and possibly a slight shortfall, and this new supply does not materialize, then prices should start rising considerably.
This is the whole point about the oil business, isn't it? It is a massive, great big tanker that you can't stop or start very easily. Do you, as a fund manager, presumably you obviously position yourself expecting there to be a shortfall of production next year because of this problem. Presumably at some point Capex will be opened up again, and presumably it'll be seen that ultimately these companies, be they BPs or the Shells or the Exxons or be they the smaller ones, someone at some point is going to have to start opening up the budget again to start drilling. What sort of price of oil does that kick in? Where on the oil price do we see Capex starting to be spent again?
The problem with that is twofold. The most important problem is the natural lag of capital expenditure to production, because from the time of spending the money to drill or develop a field to the time that it will start producing varies significantly, obviously, according to the morphology of the field, etc., but it can be years. So from the time the executives at even the largest integrated companies start accelerating capital expenditure to the point where their production figures will start showing this growth could be a significant lag, during which time demand continues to grow, and therefore exacerbating the shortage. And the second and equally important factor, I think, is with such a catastrophic drop in prices as we have seen since 2014, the natural human instinct is to be cautious. Yeah. And therefore, even if the executive, even if they see a significant rise in short-term oil prices, they will think several times and discuss with the whole board on several occasions before they start accelerating capital expenditure and endorsing particularly marginal projects that have much higher cost of production. So these two factors, I think, are likely to be a severe impediment to future supply growth, and therefore at some point in time I expect a significant shortfall.
At the moment, just what is the spread like? Because you mentioned Yangara, which is in shale. Now, my understanding is that shale is a lot easier to turn on and turn off. Right. You're talking there about the long-term projects, the Absolutely. Big deep water drilling and so forth, where they've got to do all the work, preparatory work. Do you see over the period more shale businesses coming on into funds like yours because they're able to be more responsive and more flexible in their approach to, as I say, switching it on and off?
Well, absolutely. And if you look, for example, at our top 10 positions, Yangara, Painted Pony, and Tamarack Valley are all Canadian shale producers. And these are the most price elastic part of the industry. These are the operations where they can turn around within 6 months the capital expenditure. So they take a decision to drill an additional well, they know where the oil is, they know how much it's going to cost to drill it, how much is going to be the marginal cost of production. Therefore, it's a very instant and very easy decision to take. And these are the companies that have multiple locations to drill. Therefore, as the oil price recovers, they will be the first to accelerate production and benefit from the rising prices. The others are, generally speaking, in much longer term projects that require a lot of design, a lot of preparation, a lot of infrastructure building and money. So they have a much greater lag.
Yeah. Look, it's a pleasure. Thanks indeed for joining us with a look at the oil fund that Angelos runs. Angelos Damaskos is the fund manager at Sector Investment Managers of the Junior Oils Trust, which year to date is up 22%.